3, 2, 1, 0.
All right, it is Friday again.
Yeah, man. When you're watching this, it's Sunday, so don't let that freak you out.
Oh, that's right. Well, it's Friday. It's Friday here as we're recording it.
Yeah, we always try to do this on Fridays at some point because we like to have a life.
Yeah, well,
We're still working on the weekends. We're doing all the
there's all the other
newsletter
stuff
and
we're doing on the
analysis, but doing the show on Friday helps us make room for all that. So
yep. And it's a big Friday.
we're busy little bees on the weekend.
Yeah, the weekends are very busy.
Jobs
Jobs report Friday.
Yeah.
So the expectation was 200,000 new jobs created in the March report. It came in at 303,000. Quite a bit above what
does these
expectations.
estimates? I mean, the same people that give out the real information, aren't they the ones that do the estimates, or no?
No. I mean, Wall Street's estimating, and then the government numbers come out to the numbers.
Yeah, when we were in the government, many times, this is, I guess, with I'm getting off track here, but it reminds me of our former days, where we would get these like budget estimates from the budget office, from like the congressional budget office or whatever, and then the real one would be, and there would be all this uproar, and I'm like, wait a minute, the same people put together the estimate that put together the real, like they know what they're doing. They knew it was going to be off. Anyway, I digress.
Yeah.
So more jobs came
More jobs.
and less unemployment.
Unemployment ticked down from 3.9 to 3.8.
So that means inflation's going up.
Yeah.
Theoretically.
That is
macroeconomically.
Macroeconomically, linearly, that's what it should mean, right? And so what would the next step of that be? If inflation's going up,
interest rates go up.
or it's harder for the Fed to cut rates, right? Because this whole thing,
they stay the same. Yeah.
Or they stay the same. So you would think that the Fed now going into the May meeting will have less reason to cut.
Yeah.
Right?
Which should make the market tank.
However, apparently that was yesterday before the numbers came out, because today the market's up as we're doing this, and it's almost 11 o'clock in the morning. Market's up about 0.5%.
Yeah, but there's a lot of other reasons in there as to why the market probably isn't going up.
Yeah, I mean, the technicals look pretty bad right now.
Short term, but it always has an opportunity to bounce back. But I mean, yesterday was a rough day.
Yeah.
Thursday.
We're going to get to it at the end, but Thursday was a rough day. It definitely broke some support levels that should at least raise a red flag. But we got a few things to talk about before we get there. So, got a really good question in the Facebook group, and it gives us an opportunity to talk about some things that we don't really talk about all that often. But the C fund long term, when to use the G fund as a tool and why you would use it, and then the L funds, which we don't talk about very often, but I'm glad we get a chance to talk about it here. So, and then XLE, energy sector within the ETF, within the S&P 500 is the bonus chart, and then we'll take a look at the C fund. So, question in the Facebook group. I'm new to the group, just wanted to say hi, looking to expand my knowledge of TSP. Worked for the VA since 2009, but have always played it safe in the G fund until a couple years ago, and then broke it up into the L and C and G. So that's going to be the focus of what we're talking about. I have 10% in traditional TSP, 10% in Roth. Don't feel like it's going anywhere. Okay. This is a chart of, we're going back to 94, but basically here you are coming into the VA in 2009. You wouldn't know it unless you were watching charts back then. But this top was basically, the market had been going up since the Great Depression. We don't show the chart all the way back, but it went up and down. But this move here from 2000 to 2009, so almost 10 years, was the correction that corrected the move that started back here in like 1932. So what I'm saying is this bottom is really, really important. And this was the time that you wanted to be in the stock, or ideally getting into the stock funds, not the G fund.
But you wouldn't have known that.
You wouldn't have known that.
Yeah, because none of that has happened yet. So that's
Right.
fair to say. There's no reason to believe right at that moment, even if you were kind of clued in,
Yeah.
right?
Yeah, you would have had to have been watching. I mean, it's not easy, but the the long-term chart, right, had been going up for a long time, had this 10-year consolidation, and then once it broke out from that, it just kept on going, and it keeps on going, right? So, but they don't teach you this when you come on to any agency.
God, no. I mean, that's why we exist now, is because none of this existed when we came in. Nobody was talking about it. Yeah.
Yeah. So, okay, that's where you were when you came on, and this is this is the C fund, S&P 500. This is what's happened since then. So going forward, how could you kind of manage what's happening? So presumably you don't want to watch the market every day. Each one of these ticks, right? A tick is the red or green rectangle, is 1 month of price movement. So if you're only watching the market once a month, and you're watching it go up and down, if you connect the primary bottoms, you get this trend line. And once that trend line breaks to the downside, the trend has changed, right? And it's the same way, you could do it the other way too, but instead of connecting the bottoms, you would connect the tops. And when you break out from the top, the trend has changed and now it's going up, right? So trend lines is a really simple way to kind of manage it, because you're trying to avoid this and this. Okay, this was from here to here was a 50% decline in the value of your account. From here to here was a 55% decline in the value of your account. So those are the things you're trying to avoid. And where we are right now is we're in this long-term channel, right? If you connect the major bottoms, COVID was an overshoot, right? But you connect all these major bottoms and we're in this channel. And so the question is, what do I do now? If you're looking at it on a long-term basis like this, we're approaching the top of the channel. I did this chart a couple days ago, so it's not up to date with Thursday's decline, but we're approaching the top of the channel. And so every time we've gotten close to or at the top of that channel, we got, again, an overshoot commensurate with the overshoot from COVID to the downside. We have the overshoot to the upside, but we're in that channel. So we're much closer to a top than we are to a bottom. Okay, you could expect, based on history, that we come up somewhere close to the top of that channel and head back down to the bottom of the channel line. So you can use trend lines and channels, or you can use moving averages. So in this case, it's a 20 period, and each period we said is a month, so it's a 20-month moving average line. So two ways you can do it. You can just look at the moving average line, that blue line, and when the moving average line is going up, right, price is going up and down, but over time, if that moving average line is going up, prices are going up, right? When the moving average line is going down, prices are going down. The other way you can do it is say, okay, I want to be in the stock funds when price is above that line, right? Because when price is above the line, the market's going up. When it's below the line, the market's going down. Sometimes it goes down quite a bit and really fast below that line. The downside of that is you're up here at the top in 2022. Before you get to that line to make a decision, right? Because you don't want to be in the stock funds when it's below the line. But if you're using that as your guide, you have to be willing to accept all this downside before you even get to that line. So the further we are extended beyond that 20-period moving average line, whether you're looking at a daily, weekly, monthly, the further you get extended from it, the more downside you have to take before you even get to that line. And right now we are extremely extended above that line, right? Okay. So we use the G fund as a tool, okay? this is the same chart of the S&P 500, the C fund, and this is a chart of the G fund. Okay, it's the effective Fed funds rate. The G fund doesn't have a chart, but the effective Fed funds rate is basically the chart of the G fund, and this is the percentage rate of return, more or less, that you would get in the G fund over that time. So this, one thing you can kind of notice, this doesn't get below zero, which means anywhere in here, you have some kind of positive rate of return on the G fund, right? So you're never losing money in the G fund. On the C fund, we said this move right here was a 50% decline in your account, right? This was a 55% decline. So what happens when the stock funds start rolling over, right? The Fed starts lowering rates to kind of put in a floor in stocks, right? Stocks start rolling over, Fed starts cutting rates. When the Fed cuts rates, it's reducing, right? It's reducing the amount of the rate of return in the G fund. But it's always going to be positive. So you're taking a 50% loss or drawdown in the value of your account here, a 55% drawdown here. And even though the G fund is also going down, it's going down, but it's still positive. So the value of your account is going up in the G fund, even though the G fund, nominal is going down. So it's a little bit tricky, but I think you get the idea, right? All right. So the G fund is a tool. You definitely don't want to be in it when the stock funds are going up.
Well, that's to say if you're actively managing it,
right.
And I just want to throw the caveat in there that because we talk about this a lot. Let's say you're going on vacation for 2 weeks and
sure.
You really don't want to watch the market, and you're like, I can always go to G Fund. All right, I'm gonna go park my money in G Fund because I don't want to miss out on some massive downturn like maybe that happened on Thursday. So, something like that. Like
sure.
that's a safe place to put your money. Now that's just a temporary solution, right? But like Jerry said, generally speaking, you want to be in the stock market when the stock market's going up.
Yep.
I mean, this seems like a no-brainer, right? We make it sound easy, right?
It's simple.
It's simple.
It's, not
it's just
easy.
not easy.
Yeah.
Yeah, that's where I was headed.
Yeah. So, okay. The other part of this question was the life cycle funds. I don't think people understand the life cycle funds are designed to be used, basically only that fund. If you buy into the concept of the life cycle funds, what you're buying into is that risk is based on your age. And so the idea is that when you're first starting off in your career, you want to be in the quote unquote riskiest funds, which are the stock funds. And then as you progress in your career, you get older, you want to be in the less risky funds, which is the F and G funds. So what the life cycle funds do is they decrease your exposure to the stock funds over time and increase your exposure to the F and G funds. The problem is the market doesn't care about you and how you're progressing through your career and how old you are and all that.
Yeah, it's not, the timing is not set up, right? So that you've locked it into a time frame that might not correspond with what the market's doing.
Right.
So depending on when you slide into an L fund, where is it in that sliding where it goes from less stocks to more, G and F, where is that? If you're lucky, that matches up with what the market's doing,
sure.
But that's going to be
pure luck. Yeah.
There's no way you can know.
Yeah, it's not built that way.
Yeah, and so that's the unfortunate part with the L funds. It's a great idea. It just doesn't play out well because the market's going to do what it's going to do, and if you're not, but I'll let you continue on because I know you're going to get some of this.
I'm going to go through this because it's pretty important to kind of understand. So, you have 10 L funds. They're divided up into 5-year chunks, right? So, it's diversified mix of the 5 individual funds. So the G, F, C, S, and I are all part of the L funds. They're designed to let you. It says this is from the TSP site, right? To let you invest your entire portfolio in a single L fund. Okay. The idea is if you buy into this, you want to put 100% of your account, allocation into whichever L fund you're choosing, because if you're the whole point of it is that it's reducing your risk as you go through your career, which again, risk is based in this case on your personal age and progression through your career. It's not based on what the market's doing. So if you buy into that idea, you want to put 100% of your money in the L fund that corresponds to the age in which you expect to retire. Because if not, if you put 50% in one L fund and 50% in the C fund or whatever, you're messing up the whole strategy of the thing.
Because the L fund will be moving gradually,
right,
based on its predetermined kind of time frames, and those other things won't be. So it's kind of like, kind of messing with the algorithm, if you will.
Yeah, you're defeating the purpose.
You're either in the L funds or you're not.
Right.
You don't really want to be, and you don't want to be in multiple L funds. I've run across people that'll splice it up trying to. I'm like, if you want to be in the stock funds, just go into the CS and I.
Right.
Don't try to let the L funds do it for you, because they're going to move and they're going to rebalance and all that stuff, and it's going to have no impact based on what the market's doing.
Yeah, a lot of people use the L funds for a piece and then try to play in the stock funds on the side, and it's not that you can't do it; it's just defeating the purpose. Of the
it's not really meant to do that.
It's not.
Yeah,
so
and none of this is like negative criticism. It's more like, hopefully it's coming across educational, because the idea is, like Jerry said, bottom line is they built the L funds to either be in one, based on when you plan to retire, or not do that as your option.
Right. A lot of people will do the most furthest out L fund and keep changing to the further one every 5 years, and you are absolutely defeating the purpose of the L funds when you do that, because you have to buy into the idea that as you progress in your career or age, you want to be in less risky funds. You want to reduce your exposure to the stock funds.
Right.
If you keep transferring to the next later fund, you completely defeated the purpose of
right.
the
You
being
should
in the
just stay in the stock funds.
Right.
Don't stay in the L funds. Right.
Okay. So every quarter, the target allocations for the L fund, except the L income, because that basically stays the same. But the allocations every quarter gradually shift from what they say higher risk reward to lower risk reward, right? They're reducing your exposure to the stock funds as it gets closer to that target date. When an L fund reaches the date it goes out of existence, any money that's in there goes automatically into the L income fund. So now you're at the least risky, right? You've retired, is the idea. Okay. One of the important things about the L income fund is that it sticks to the target allocations for a full quarter, regardless of what the markets do, right? That's what we're saying. It doesn't. The markets do not affect the L fund. The L fund's going to do its thing regardless of what the market does. Every trading day, some of the individual funds in an L fund will do better than others, right? Because the funds are made up of the 5 core funds. Some of them are going to do better than others. At the end of the day, the individual funds that did better will make up a higher percentage of the L fund than the ones that did less well, which makes sense, right? Because if you're, say, evenly distributed across those the 5 core funds, whichever fund on any given day does better now has a higher weight at the end of the day than it did at the beginning of the day, right? If the C fund does better than all the other funds, at the end of the day, that C fund is going to have more weight now than the other funds do. So that means the C fund outperformed the other funds in that example, okay? And so what does the L fund do? To maintain each L fund's target allocation, we rebalance it at the end of every trading day. We do this by buying and selling the individual funds that make up the L fund so that the percentages go back to what they were at the beginning of the day. Okay? So if you're in an L fund that's evenly distributed between the 5 core funds, and the C fund outperforms the other funds, let's say, that means the C fund is moving up relative to the other funds. What does the L fund do? It goes every day, it goes back and puts the percentages back to where they were at the beginning of the day. And so they say, in effect, we're buying low and selling high at the end of every trading day. That's true. They're in effect buying the underperforming funds, right, and selling the outperforming fund to bring it back into the level where it was. So this kind of goes to a core investing principle. Either you want to buy and be in the funds that are going up, or you want to try to buy low, with the idea if a fund goes down, if I buy it that day, I'm hoping that it's going to turn around and go up. But which is one way to do it. Another way to do it is to be in the strongest funds. It would be great if they had an L fund option that was the opposite way of rebalancing, that you were selling the ones that were doing worse and buying the ones that were doing better. But that's not how it works. So hopefully that gives you guys some insight into the L funds and how it works and the pros and cons of it. A lot of people use the L funds, certainly industry. Life cycle funds are throughout the financial industry, and it's a great way
Yeah,
for
not
the
just the
financial
TSP
industry
does
to
it.
make money. Yeah.
Yeah, I should have talked over that part because that's a very important part. Say that again, Jerry.
It's a great way for the financial industry to make money.
Notice he didn't say you to make money.
Yeah, no, not
Yeah.
you. If you make money, great.
Yeah, but it's not going to be on purpose. That's the problem. And you know, we obviously are biased against the L funds. If you've been following us or watching us or anything that we talk about, but mostly because, you know, once you realize the market's going to do what it's going to do, the idea that the L funds automatically adjust based on age, not on what's happening in the market, it just doesn't make much sense. Now, it might be better than nothing, right? And so let's say if you just have no other option, meaning you don't understand enough. And again, back to the question or the comment, you know, from in the Facebook group, you know, they fully admitted, like, hey, I didn't know what I'm doing. I still don't kind of know what I'm doing.
Right.
And well, hopefully you found the right place. I mean,
Yeah.
hopefully over time you'll get educated enough by, you know, being in the group and by watching the show and what have you, that you'll learn how, you know, because people always think we're trying to get them to do it the way we do it. And that's not the case.
Yep.
We're hoping we can show you all the ways to do it, and at some point you choose what works for you.
Right.
And if the L fund works for you, then do it. But do it. Don't kind of halfway do it, because you're defeating the purpose of the L fund, as Jerry pointed out.
I mean, just understand what product you're buying.
Right. Understand the fundamental principles of each one of these choices.
Yep.
You know, there's buy and hold, there's L funds. Those are generally considered very passive approaches. I mean, you're not doing anything. You put it in the L fund for your given year and you walk away.
Yep.
Or you buy and hold and you walk away. Every other version means that you're staying in tune with what the market's doing and you're doing your best to kind of adjust your portfolio, which funds you're in based on what the market's doing. Right. That's really your only options.
Yeah, that's all there is.
That's it. There's passive and there's active. The active part is you're paying attention, you're trying to move. Now, once you get into that world, there's lots of different ways to kind of play the game. But if you don't want to do any of that, your options are buy and hold, and those aren't necessarily wrong.
No.
It's just that you have to know what that you have to know the pros and cons.
Yep.
Pros are you don't have to deal with it, and the market does generally over time go up.
Yep.
But if you go back to that chart Jerry showed you, there are decades where it didn't, and so you have to accept those. But if your 30-year career is in the wrong part of that chart, your world looks different.
Yep.
Right.
Yep. 100%. Yeah. Actually, let me go back to that for a second. Now that you say that, if you came on in 2009 and you defaulted to the C fund because everybody told you to be in the C fund,
You'd be a very happy person.
You'd be a happy person.
Yeah, and nothing wrong with that.
No. If you came on in 2000 and everybody told you to go in the C fund,
pretty much like we did. Well, we came in the 90s, but
you didn't make any money for 13 years.
Yeah.
Now you were contributing all the way along, right? The market's going down, you're contributing. Market's going up, you're contributing. So your contributions matter. But if you had $1 million in TSP here in 2000 and you're in the C fund and you're like, well, I'm gonna stay in the C fund, you lost half of it. You woke up one day down here and your $1 million was 500,000. You stayed in it, right? You say, well, the market will come back. So it does come back. Now you get your $1 million back, right? Not counting the contributions that you made along the way, but you got your $1 million back. Then a couple of years later, now you're down to less than $500,000, right? Then it took you until 2013 to get your $1 million back, and then now you're starting to make additional money. So
Yeah, you were flat that whole time.
yeah.
And that's if you follow us long enough, you'll see that what we try to do is not be in during those long downturns.
Yep.
Now, you can't catch it at the top and the bottom. It's almost impossible. It'd be lucky if you did. But you can get out on, especially when there are long-term trends like that.
Yeah.
You can sit on the sidelines in the G fund, and that's what we do is we go to a safe place that's not going to get a negative return. It may not get a high return, but at least it's not negative.
Right. Okay. All right, bonus chart, energy. So XLE is one of the 11 sectors that make up the S&P 500, which is our C fund. So this is what energy looked like. This is a weekly chart. Again, this week is going to be a little bit different because I made the charts before Thursday's kind of collapse in the market. But energy bottomed back here in 2020, had a pretty good run up, and has been in this sideways consolidation, right? It just broke out above all these prior highs, right? So energy is looking really strong. The chart looks really good, the weekly chart of XLE. If you do energy XLE divided by the S&P 500, it gives you the ratio, right, of what energy is doing relative to the S&P 500. Because even though, energy is breaking out, right, but I want to be in the sectors within the S&P 500 that are doing better than the S&P, right? Because if your objective is to outperform the S&P, you want to be in the sectors that are outperforming. So how do you know? How do I know that this nominal chart is actually doing better? Why wouldn't I just have my money in the index? Because the ratio is showing that when the ratio is going up, the XLE is the numerator. So the XLE is outperforming the S&P 500 when that line is going up. So if you remember back in 2002, this was January 2002, the XLE is really outperforming the S&P 500 on a relative basis, right? Because this is the ratio chart. But in reality, XLE, here's 2022. This is what's actually happening. The XLE is actually going up when the S&P 500, if you remember from January 2022, the S&P 500 was going down. So you were actually making real gains if you were in energy while the overall S&P 500 was going down. Okay. So the ratio chart is what tells you that. The last thing about energy, and this is kind of an important one. Generally speaking, and it's a little bit tricky to show, but generally speaking, here's the bottom after COVID, right? Energy, and so this is not a ratio chart. So energy is this one, and the S&P 500 is in orange. Okay. So they're going up together out of the bottom in COVID. Energy comes down as the index starts really moving higher. Okay. Generally speaking, when the index is moving up, energy is moving down. Okay, but it's not a 1-for-1 correlation, but generally when energy tends to outperform when stocks are going down. So energy's going up, stocks are going down. What's important about this one, when energy started to tick up, the stock market started to tick down. When energy starts ticking down, stock market starts moving back up. And a lot of times it leads. Energy will lead. So when energy starts turning up, it's an indicator that the stock market is getting ready to turn down. Right? When energy is turning up here, the stock market's getting ready to turn down. Since December of last year, energy has been going higher. And the stock market has continued to go higher. But it's a red flag, right? It's telling us that when energy starts going up, you have to be at least aware of a potential turnaround in the stocks. Okay. So the C fund chart. So here we are for the week. This one goes through Thursday's close. So this trend line, okay, all I did was basically connect the bottoms since the beginning of the year. Okay. And that trend line has held support all the way through until Thursday. Okay. This is on a weekly basis. So it doesn't necessarily mean that the market's getting ready to crash. You know, it could definitely turn around and keep on going. That's a possibility. But the break in the trend line is, if nothing else, a red flag that things are changing. Okay. So if the market was to roll over here and keep moving lower, where would we likely expect it to stop? You got this support level from the high in January 2022. The only little bit of correction we've had since the low in end of October last year was this section right here. So if you just do a channel, we would expect price to come down to somewhere in this channel and find support there. If it broke below that channel, you know, it's going significantly lower. But on the next, you know, decent correction we have, it's very likely that we get down to test this support level right here before we keep going higher. Okay, and that would actually, if you do a longer term trend line, it would be something like that. So that's kind of what we're looking at if this correction does continue. That's on the weekly. On the daily, you can kind of see it a little bit closer. I mean, it's the same trend line, and it's got a little bit more room, right, for price to go lower. So I didn't keep the trend line as tight as I could have, but even at that, Thursday's break in the trend line is pretty obvious. So if you're looking on a daily basis, you know, that's kind of where we are. Doesn't mean the market's gonna, you know, roll over and go straight down. The market can go three ways on any given day, right? It goes up, down, or sideways. And we got a top here, here, and here. So we need to get back above this high before we can expect the market to continue moving higher. So we have a lot of upside resistance right now. We got a big break in the trend line. So yesterday's price movement just increases the odds that either we go sideways from here for a while or we go down, right? Before that, the trend was up. Now that trend is no longer in place. So now the possibilities is sideways or down. And there's a possibility it can turn around and go back up. But we've drastically increased the odds of sideways or down. And then to the extent that you want to let it play out, you know, how far do you want to let it go down before you say, okay, I'm going to cut my losses and move to the G fund? That's the individual decisions that we have to make. Okay. Oh yeah, the last way, you know, we always talk about this 20-day moving average line. So if you didn't want to use trend lines and you looked at the moving average line, it's pretty close, right? Once we got a breakout there in November of last year, every time we've hit that 20-day moving average line, we got support until Thursday. So it's just another tool to look at to decide, to identify this as a red flag. Okay. Hopefully that gives you guys a little bit of insight into the L fund, certainly, and what to be looking at throughout your career and how to kind of manage it. And we do day-to-day analysis, certainly, of all this. And so if you're a subscriber to the site, you've gotten some good information over the last day or two, and you know how we're playing this market going forward.
Absolutely. If you have any questions about anything we've talked about, please put them in the comment section wherever you found the video. If you don't find a comment section, you can always shoot us an email at support@growmytsp.com. We love getting questions in the Facebook group and questions in our inbox because it helps us figure out what you guys want to talk about.
Yep, definitely.
All right. If you like the show, share it with your friends. If you don't, share it anyway. And we hope you guys have a great week coming up, and we will see you soon.
Out of here.